Well, you're very welcome to episode 345, where I'm asking you not to be the magpie. Magpies here are, of course, famous for chasing shiny things. Don't be the magpie. Do yourself a favor. I'm going to share some research that proves why it is wise not to be a magpie, and also some tips around how you can avoid being a magpie. All will be revealed very soon. Um, in other news, very briefly, we were delighted to be nominated for two financial services awards, which are coming up in October, November in Dublin. They are sponsored by KPMG. They're properly adjudicated. I might regret saying that if we don't win, but if we do win, I'll be delighted. But no, it's wonderful to be shortlisted for two awards. One under Challenger, where a company in financial services is trying to do something differently. We're up against the likes of Revolut and some other big hitters there. And we have also been shortlisted in the trust category, where we've put forward at the basis on which we educate, inform, advise, and guide clients on an ongoing basis, and the transparency that we operate to, and the level of rigor and due diligence and protections for clients that we adhere to and embrace, I suppose, is probably a better word. So yeah, two awards that we've been shortlisted for. So we're delighted about that. Pardon my voice. I'm coming down with what everybody in the country seems to be coming down with, which is a severe bout of man flu. So that's all the news here in HQ. Hope life is good in your world, and that things are well. Is there anything else? No, that's the main stuff, really. Okay, that's the main thing that's going on around here. Excuse me. Here we go. The reality is that lots of investment vehicles out there have delivered really decent returns over the last 10 years, but most investors have underperformed the vehicles. Yes. Bad behavior has got in the way of them achieving the returns that the vehicles they're invested in have delivered. Hence the magpie reference, right? They see shiny things, they make changes, they do stuff, they try and chase returns, or they try and make alterations to avoid temporary declines, and they end up costing themselves money. They try and time stuff, entry, exit. They try and beat the market fundamentally, and they don't succeed. That's the bottom line. On average, it's going to cost you the guts of 1.5% per year, which compounded over 10 years is 15 bloody percent of a pot difference. If you're accumulating pension pot of £1 million over 10 years, that's 150 grand that you've done yourself out of by trying to do yourself into 150 grand extra. That is what happens. And this is backed by real research. The return gap, right? That's what it's known as, the returns gap. Morningstar publish a really fascinating piece of research every year called Mind the Gap. Okay. Oh yeah, that was the other thing I was meant to say to you. Sorry. It is now the 29th of September, Monday the 29th of September. This Friday, the 3rd of October, we have a webinar, 11 a.m. on Friday, 11 a.m. with Alan Purcell from Cloud Accounts. Go to informeddecisions.ie, click on the blog title, and go to this week's blog. It'll be something about a magpie. And in the first couple of sentences there, you'll see a link to register for that webinar. That is the way to do it. That is how you do it. If you're on our mailing list, you'll have received an invite. It is a public webinar, and Alan is going to tell us how to fill in Form 11 and Form 12 tax returns and to make and save some tax. So, hey, who isn't up for that? Jump on the bandwagon and join us for 40 minutes or so this Friday at 11 a.m. back to the topic. I'm very sorry about the interruption. Morningstar Mind the Gap Research 2025 research is out, where they show 10 years of data. Okay, so they analyze and assess 25,000 US, of course, mutual funds, which are like actively managed funds, and ETFs, which are passively managed funds, to look at the performance, and then they look at the actual returns that have been achieved in that 10 years up to the 31st of December 2024. And the key takeaway is funds returned an average of 8.2% per year, okay, for the 10 years, 8.2% per year. So if you'd invested a lump sum at the start, so on the 1st of January 2015, by the 31st of December 2024, you'd have achieved an average annual return of 8.2% compounding. That's what the fund did, or the vehicle, or the investment that they assessed of the 25,000. That's the average. But the actual investor returns that they achieved was 7%. Okay, so it's 1.2% less per year compounding underperformance. That's not because of fees in there, but that is because of bad behavior. That's the behavior gap. 1.2% per year returns is what it cost. Mistimed buying and selling, chasing hot funds, panicking when markets get scary, which they have done a lot of, in fairness, over the last decade, and just tinkering too much, buying and selling stuff, moving stuff around. That is the reality. It has cost that level of return. And here's this thing, even good habits like drip feeding investments, for argument's sake, can contribute to this gap because their money isn't invested for the full period. You're timing it and sequencing in, which I've spoken about, and I totally empathize with, and I get the logic for it. And we have some clients that do it. But really, if you want to get in, history has told us time and time again, the best time to get in is when you bloody have it and you can and you want to, not phasing it. That has cost, per the research, that has cost people. And obviously then the bad habits such as panic selling and, chasing what's shiny, ultimately they really do the damage. That's the reality. And across the board, there's underperformance per different asset classes, right? So for argument's sake, we take allocation funds like target date funds, which are somewhat common. They're fairly common in pension funds in Ireland, to be honest, right? Where there's a specific target date where you plan to retire and the investment vehicle is lined up to that. And lifestyle investing will be similar ultimately in that regard. They had the narrowest gap, so the narrowest underperformance, where investors ultimately captured nearly all of the returns, right? And why was that? Well, because these funds automate the diversification and the strategy. The investor can't get in and tinker with it and mess around with it and make a hames of it, right? You can't act the magpie in there. So that's one. Allocation funds were the best underperformer, if that makes sense. Sector equity funds, so had the widest gap. This is where investors missed out on full 1.5% every single year here. These are often speculative funds, chasing tech or energy booms or fads. It's kind of like thematic investing, which I see some companies here kind of advertising and promoting as a way to lure people in and appeal to their inner magpie. This is basically chasing the current in vogue strategy. So AI data centers, semiconductors, ESG a couple of years ago, the list goes on and on. Every year there's something new that ultimately firms see as an opportunity to flog and to appeal to the inner magpie. And there's a bit of magpie in all of us, right? If we're being honest. The key is not to listen to it or to not let it out. Don't release the magpie. Don't feckin' do it. Another weak spot was bond funds. So again, it's very, very difficult to time interest rate moves. And it's one that people think they can do, possibly more so than they can time and predict equity and market moves, but they can't, right? It is absolute fallacy. Don't do it. So people have underperformed in bond funds, not because bond funds have done badly, but because they have been buying and selling and thinking that they know what's going on when they clearly haven't been. They haven't had any knowledge about that. And then ETFs delivered higher raw returns, but had bigger gaps, bigger underperformance for investors than traditional mutual funds. Why is that? Because, well, it's an advantage. They're typically fully liquid, right? So you can trade an ETF on a day. You don't have to wait. There's no lock-in periods. There's no obvious drawback to trading. So there tends to be more trading going on in ETFs than in anything else. And when, your DeGiro and your interactive broker investor can see, I can buy and sell this, bang, bang, I'll do that. Such and such are announcing results today. I can sell that because I think they're going to be terrible. I'll buy it again tomorrow and it's down 20% or whatever logic goes on. That's where that's where investors have underperformed. The pattern is clear, ultimately. The more opportunities we have to do something, the more likely we are to sabotage ourselves as investors. And it reminds me of that wise investments mantra, wherever it came from, or whoever and said it. Don't just do something, sit there. I remember hearing Monish Pabrai, who's an investing bit of a genius, to be fair. He's from India, based in America. Monish, Mohnish Pabrai, Pabray. Really interesting guy if you want to look him up on YouTube. And he's a fund manager, kind of the Guy Spear kind of cloth, value investor. Remember seeing him at a conference or a speech he gave in Trinity. He just happened to be passing through Dublin. Like, he had a stopover in Dublin on his way from India or to America or somewhere. And he was sharing research that the best investors are those where the account holder died many years ago because they weren't fucking messing around with it. So that's kind of the same philosophy. Don't just do something, sit there when stuff is going crazy or stuff is going exceptionally well, and you want to do the Magpie on it. So why does this underperformance happen? Well, ultimately it's down to human behavior. That's the bottom line. And that's in end investors, it's fund managers, it's right across the board. We're wired to act. It is very difficult to not do something when stuff is going bananas, positively or negative. We want to flee when markets fall and we want to chase shiny things when they rise. That's totally natural. We want to do it. The key thing is, recognizing when we should and when we shouldn't, ultimately, right? And that's the challenge we have. We can't recognize when we should and when we shouldn't. We feel we should. And so people who do have underperformed. That's the bottom line. Morningstar also found a couple of other nuances to this. Higher tracking error funds, those straying from the benchmark. So there's such a thing as tracking error. So some funds will have a very narrow tracking area or small tracking area error. They will deliver the returns of the index, and others will have a big tracking error, right? Due to how they buy and sell and try and mimic the market and the index. Ultimately, investors struggled to stick with them when they're buying and selling. Funds with volatile cash flows, lots of people piling in and piling out, had worse returns. More trading, less returns. Cheaper funds had smaller gaps than expensive ones, but that wasn't about cost. The key was context. Low-cost funds are often core holdings in advised retirement and investment accounts, where investors have an advisor between them and their buy and sell button, ultimately. And so we're more inclined to leave them alone and to do well as a result. That is one of the greatest values that we are to many clients, is that we are the barrier between them and their buy and sell button. They can access it if they want to, but they would always talk to us before they do. And so quite often people say, you know what, actually, geez, I'm delighted I've had this conversation. Leave it alone. That's the right thing to do here, right? And that's the reality. I just see out my window here, looking at clouds, nice strata clouds and a blue sky behind some of them. There's a little cloud with a hole in the cloud. It's almost a perfect rectangle. It's not too often you see that. Anyway, I digress. Um, Markets matter, fees matter, fund choice matters, but our behavior as investors matters most. Ultimately, is the mantra. Okay, it's not about picking the best fund, although that helps. It's about capturing as much of the return of whatever we're in that really matters. Okay, because we are where we are for now. It's about behaving our way to success. If your fund or what you're investing has earned 8%, but you only pocket 7% per year, that's not a market problem. That's a behavior problem. I said that's excluding the question of fees, of course, right? If the market delivers 8%, you're paying 2% fees, and then well, the best you can get is 6%. And if you're only getting 5%, then whoa, that's it. Now we have a problem, right? Okay, so how do you close the gap? Well, again, there's 5 quick things that I want to share with you to help close the gap. Automate. Remove yourself from everything that you can. Right, just much like Daniel Crosby interview we had a couple of months ago, probably at this stage, when we had him back for the first time in 8 years. Automate everything. Right, that was his thing. Automate stuff. Make life easy. Make things easy for yourself. Get out of your own way, or whatever the exact expression was something along those lines. But the Morningstar study shows investors in automated, all-in kind of approaches where captured most returns, where they the rebalancing was automated or done by their advisor, where the investment decisions was done with and by their advisor, where they couldn't interfere, where they've been removed from it for their own benefit. They did better. Automate contributions, rebalancing, and even withdrawals in retirement. Automate that. All right. Set that up with your advisor and just automate it. Review it, of course, every year or two, but get out of the way. Just go and spend it and enjoy it. Less tinkering. Have an advisor on the pitch who'll stop you or will challenge you when you're about to make a big mistake and can possibly talk you down from wherever it is you are. All right. Low cost core holdings. While cheap funds aren't a silver bullet, low cost, they tend to be used in a more disciplined way. That's the reality. Lower cost means there's less action in there. There's less fees in there. There's less buying and selling in there. That's all kind of, that's a compounding value I admire in a fund. Build your portfolio around globally diversified, low cost, funds, ETFs that you can hold for decades. And that's assuming this kind of strategy meets with your volatility, risk rating, and your ability to bear loss and your risk profile, etc. Disclaimer. But just go with that low cost approach. Has proven to work. Beware of exciting funds. I was quoted in the Sunday Times Sunday just gone, regards to Arena Capital, an unregulated investment, another one gone bad, and over 100 million of investor money at risk now of total capital loss, and lots of concern for people out there. And I continue to beat the drum for transparency and greater consumer protections around these things. Specialist funds like tech and biotech or energy can look tempting, but that's also where the biggest gaps in the Morningstar research appear, and indeed capital risk, depending on the type of product or loan note that you're getting into. If you must dabble, keep it tiny and treat it as fun money, ultimately, not core money, is something that I would encourage people to do. Reduce trading to a minimum. Ultimately, the data is unambiguous. The more you trade, the less you earn. Right? That's the reality. Before making any changes, ask yourself, am I reacting to headlines, fear, or FOMO here? Or is this genuinely part of my long-term plan and strategy and logic? If it's the former, resist and sleep on it, at least for a night before you act. Speak to somebody. Speak to your advisor if you have one. Speak to God if you have one. Speak to somebody. Chat it out. And then build a margin of safety. And this, I think, is kind of a logical one. If you have a financial plan, You know, Morningstar suggests haircutting your expected returns to account for inevitable gaps that may appear. For example, if your financial plan assumes 6% gross growth, maybe plan for achieving 5% if there's a probability that you're going to be messing around with it. Even if behavior costs creep in, then your retirement plan should remain intact. And look at conservative, much rather be conservative in prediction and exuberant in reality than the other way around. What's the role of a financial plan in all this? Look, we have to get the spoke in somewhere here. Like, ultimately, a solid financial plan and a proactive, decent, bloody financial advisor that's not a product seller should ideally be your anchor here. It sets out they sets out your long, short, and medium term goals, clarifies the role of each investment pot, as I call them, and helps you easily stay the course when markets test your nerves or tempt you with shiny things to not be the magpie. At Informed Decisions, we often remind clients the markets will do what it does, but your job is to control what you can, right? That's costs, discipline, behavior. Go and spend your money. Or if you're still accumulating, go and work and keep accumulating. Forget about the rest. That'll look after itself. Let us worry about that. You do what you do, right? Stick to your lane, so to speak. The rest is noise, but that's the point here. The rest is feckin' noise. That's why financial planning isn't just about numbers. It's motion, perspective, thinking about future selves and what we want to achieve. That's how I see it. When you know your plan is robust, my experience is that you're much less tempted. Is that the correct way to say it? You're less tempted to make rash decisions or to worry. You're less tempted to be the magpie. Plus, you'd hope your financial planner or advisor would have helped you stay not simply invested, but invested in productive vehicles and strategies. That's the key. So I'm sharing on our blog. Go to blog.ie, informeddecisions.ie. Is there a blog.ie? That would be a great one to have. Go to informeddecisions.ie, click on the blog and go to the Magpie article and scroll down towards the end of the page and see a graph. And that is a sample Vanguard 90% equity, 10% bond portfolio we've deployed for some clients over the last 10 years, which has delivered 165% gross in that same 10 years, or 10% annual returns during that same period of the Morningstar research, in which the funds returned 8.2% per year. You want to be in stuff that's going to work. Final thoughts. Mind the Gap 2025 study is sobering, but it's also a great reminder of some key basics, right? That's the reality. It's a great reminder. The biggest detriment of success isn't about the performance of the MSCI or the S&P 500 or the Euro Stoxx 50 or whatever it is that you're watching. It's whether you stick with your strategy through thick and thin, ultimately, that has the biggest impact on outcomes. The gap isn't inevitable. That's the good news here. The gap is not inevitable. Leave it alone. With the right structures, mindset, and support, you can tilt the odds firmly in your favor. You will achieve the returns of the markets. That's what we help clients do. It's not rocket science. We get the returns of the market. We don't underperform the market. Whatever market we're allocated to for that individual household and plan, we get the returns. That's it. Investment success is less about picking winners and more about avoiding unforced errors. Have you ever read the book The Inner Game of Tennis, which I did a few years ago when I was trying to become the next Andre Agassi at 40 odd? Didn't work, but the book was very interesting, and it's all about that concept of tennis isn't won by hammering amazing shots deep into the back corner. It's about by being consistent. Get the ball over the net. Keep it between the ditches, as they might say. Keep it between the ditches. how many analogies can I throw at this? Too many. But ultimately, I hope this helps. And, the financial media is whipping us into a frenzy. So when the next slap in the chops comes, maybe read this aloud each night before sleep or play this podcast. Don't do that. That couldn't be good for you. And in all seriousness, I do hope it helps. I've enjoyed creating it. I hope you've enjoyed listening to it. Thank you very much indeed for listening. Don't be the magpie. You're a legend.